How do a company's prospects for generating cash and growing its assets change over time? This tutorial explains how HOLT builds a concept of mean reversion, or fade, directly into its valuation model. Fade influences a company's future CFROI and growth levels. In essence, fade is decay in excess returns on capital, or CFROI. It is the tendency of all firms, regardless of their current level of operating performance, to eventually perform in line with the average company. Take Eastman Kodak, for example, which pioneered photography for the public. During the 1960s, Kodak's CFROI surged on sales of its Instamatic camera. Kodak earned high stable CFROI above 10% for much of the late 1960s and early 1970s. By the middle of the 1970s, however, Kodak's CFROI levels had fallen to below 6% and even turned negative in the late 2000s. Another example of fade is offered by Nokia. In 2000, the Finnish maker of mobile phones was earning CFROI close to 30% and had a market cap well over $200 billion. Competition arose, and by 2011, the company had a dramatically smaller market cap of just $20 billion, with CFROI levels very close to 6%. Fade happens for a number of reasons, but a simple explanation is that high returns on capital tend to attract competition, causing them to fall. Over time, companies tend to revert to the mean rate of return on capital. HOLT's empirical research shows that the long-term average CFROI for global industrial and service firms is around 6%. Built into the HOLT valuation model is the notion that returns on capital for all firms work their way through a natural life cycle, ultimately fading to these observed averages. Early startup firms tend to invest heavily in their businesses, establishing a foundation for future success while posting returns on capital that are often below their cost of capital. Mid-cycle companies bear the fruit of earlier investments, earning CFROI in excess of the cost of capital. These higher profits attract competitors, however, increasing the likelihood that CFROI will fade. And late-stage firms exhibit classic symptoms of overinvestment, thin margins, and higher leverage in concentrated sub-industries. CFROI levels are often barely above the cost of capital. While this happens at varying rates for different companies, no company is immune to fade. When CFROI levels fall below the cost of capital, management teams often try to improve them using tactics such as consolidations, asset sales, and reorganizations. Occasionally, mature firms and industries experience a fresh wave of innovation and growth, and the life cycle starts anew. A clear example of the life cycle is Apple. Apple's CFROI level was 18% in 1990, but returns on capital faded quickly over the next 5 years to under 6%. In 2001, Apple delivered CFROI of -1% and had a market cap of $16 billion. Due to successful restructuring and product innovation, however, CFROI continually improved over the next decade. By 2011, Apple's CFROI levels were forecasted to be above 25%, and its market cap was over $300 billion. By studying past data, HOLT can make an objective estimate of a company's future CFROI levels and growth rates over time. Displayed as a black line on the relative wealth chart, this objective forecasting process is consistently applied to all companies, resulting in an objective starting valuation for every firm. To forecast a particular company's mean reversion speed, or rate of fade, the HOLT methodology considers 3 main factors: the present CFROI level, the volatility of the CFROI trend, and the asset growth rate. Research shows that CFROI level is one of the best predictors of fading profitability. Put simply, high returns on capital tend to draw a crowd. The more a company's CFROI levels deviate from the global average of 6%, the faster these returns on capital tend to fade to the long-term average. Apple, for example, has high CFROI levels that are forecast to decline from 26% to 20% over the next 5 years. This is not a statement on Apple's products or business model. It's simply the typical fade pattern for firms that have earned similar levels of CFROI in the past. In contrast, natural gas company El Paso is at the other end of the spectrum, with low CFROI levels of 3% that are forecast to improve to 4%, closer to the long-term average. Volatility is also a strong predictor. The greater a firm's volatility in historical CFROI, the faster the firm tends to revert to the long-term average CFROI of 6%. Compare Grupo Televisa to Walgreens. Both firms are forecast to earn 9.8% CFROI next year, represented by the pink bars. The wide swings in Grupo Televisa's CFROI levels indicate that its profitability is likely to decline more rapidly than Walgreens. In fact, Grupo Televisa's CFROI levels are forecast to fall to 8.5% over the next 5 years, while the incredibly stable returns on capital for Walgreens indicate that its CFROI will decline slightly to 9.25% over the next 10 years. The final predictor, asset growth rate, is inversely related to fade. Slow growth companies are forecast to fade more slowly than high growth companies. Compare Nestlé to eBay, for example. Both firms have near-term forecast CFROI levels around 15%. Due to higher asset growth rates, however, eBay's CFROI are forecast to fall to 10% over the next few years, while CFROI levels for Nestlé remain stable. As a result, eBay's black forecast line has a much sharper downward slope. As with CFROI, asset growth rates also fade over time. Our empirical research shows the same factors that impact CFROI fade, CFROI level, CFROI volatility, and asset growth rate, also drive asset growth fade. This makes sense conceptually, since cash is needed to invest in assets and companies cannot grow at rapid rates forever. An additional factor in asset growth fade is market cap, as small companies can generally grow faster than large companies. Asset growth fade is a key component of the HOLT valuation model since it impacts future outflows and inflows of cash. HOLT's fade inputs, developed during 30 years of corporate lifecycle research, are an important part of an objective approach to valuation. These inputs can be changed for any of the 20,000 stocks in HOLT's database, allowing you to compare your own assumptions about a company to the expectations of the market and gauge whether a stock is overvalued or undervalued.